Arithmetic, just to recap it again, if you have 3 stocks, let's say over the same period of time, one went up 10, the other went up 20, the third one didn't change at all. If you had equal amounts of money invested in all 3 of those, you just take the arithmetic average of the 10, the 20 and the 0, and that would be your rate of return. In that kind of a scenario where it's the same time, different stocks, arithmetic is fine. But if you're going across time like we are in this example here, geometric is the way to do this stuff. In fact, the time value of money calculations that many of you might have learned to do through tables or on your calculator kind of presumes geometric is the nature of the business. Other types of rates of return that you might have encountered in early finance classes that you've taken or attempted to take is the dollar-weighted return. Sometimes it's called the internal rate of return or the IRR, where you have an even more complicated version of the situation that I just described. You have multiple amounts of money over multiple periods of time. Excel, other spreadsheet calculators help you kind of do those kinds of things. But again, I'm just trying to give you a sense here of how rates of return kind of work. Before I move on, I should mention one other thing as well. People, when they're first exposed to this kind of material, think in terms of, okay, so if something went up from 100 to 120 and I have a 20% rate of return, have I made that money? I haven't sold anything. I bought something for 100, but I haven't sold it. Have I actually made that money? The distinction that you want to think in terms of, and we will address this anon as well, is it's when you sell something. You bought something for 100, you sell it at 120. When you sell it, you realize a gain or a loss if the situation whether the stock actually dropped below 100. But selling is the act of realizing a profit or a loss. Until then, it's a rate of return. Think of it as a paper rate of return. If I were to sell it, then I would make 20%. So we don't really think in terms really of realized and unrealized at this stage of the game. It is how much something has appreciated by. When it starts coming to things like paying taxes, that's when the notion of realizing a return and paying taxes on profits, or realizing a loss and using that loss to offset other things, that the notion of realization and not realization tends to matter. So let's take a look at that case. It's the same example again now. $100 that you started with, or 100 rupees, compounded to 120, except that now the wrinkle that's been introduced is that you have a tax rate of 30% that you pay, and it's a tax rate that you pay as you go. So in the first year, notice what happens. You had a 10% appreciation in the underlying asset, call it a stock for whatever, for practical purposes. The asset appreciated to 110. The assumption being made here is that you sell it, you have a $10 profit, 100 to 110. You pay 30% taxes on it. Your tax is 3, so after taxes you have $107 at the end of the first year. So you can think of a pre-tax rate of return of 10% and an after-tax rate of return of 7% for that first year. And then this compounds as well, this cumulates as well, not compounds. Look at what happens the next year. The asset appreciates yet another 10% from 110 to 121. Now that you've imposed taxes and you've actually taken the gain, the assumption implied in here as well is that you reinvest that 107 back in the same stock. It appreciates 10%, its future value is 117. Now you pay taxes the second year as well, but now you pay taxes on 1070, which is the appreciation in the price. That 1070 results in a tax liability of 321, and your after-tax dollar value, future value, whatever, however you want to think about it, is 114.49. From here to here as well, that translates into a 7% rate of return. So you can think of it cumulatively. 100 goes up at 7, and again at 7 to 114.9, or you can think of it as something compounding 10% before taxes, take out the 30% return from that as 10 times 1 minus the tax rate, and you end up with a 7% after-tax return. So when you account for taxes, you can either do it this way or you can do it that way. This is just the top part of this graph is just sort of illustrating for you how the numbers actually shake out. The bottom part is really the way you want to think about this. But do not forget that the assumption that's important in here is you go from 100 to 110, you pay taxes, you reinvest, you pay taxes again. If the world doesn't work like that, then the 7% after-tax return is not an accurate reflection of the after-tax money that you made on this investment. And that's what I think the note here says. The assumption implicit in this calculation is that taxes are paid as you go. If you have a tax advantage investment, say you have money in a pension fund for people in the West, an individual retirement account or an IRA or a rollover account of any kind, that's tax advantage, and those are issues we'll get to in a little bit, then the way that which you account for taxes tends to change a little. But again, I'm just trying to keep us all on the same page as we start understanding how rates of return are calculated in this investments business.